Okay.
Both came. And then I would buy. 123.
How you doing?
Doing great.
Good.
How are you?
Good, good. Much better today.
Much better.
Okay, everybody ready?
Yes, sir.
Get Dennis to behave. That's a full-time job.
Hey, I wouldn't want your job.
Well, they could.
Y'all ready?
We're worse.
Private lessons are later.
Okay.
They're for free.
Okay. Well, thanks everybody for coming. It's good to see a big crowd. First meeting of the year.
Yeah.
And I wanted to go over a couple of strategies that I've been playing with this year. And I'll share I've got a spreadsheet. I'll share my results, the good, the bad, and the ugly. But they're pretty interesting strategies. They're all involving the SPX. And they're shorter term, they're 7-day trades. Of course, you can always change it to anything that fits your trading style. But let me see if I can do this. And then we have some people that are joining us remotely. So I'm going to try to watch for their questions and admit people as they come in. But if you guys have questions, just shout them out. Better if you ask me a lot of questions. So the agenda for today, I'm going to talk a little bit about SPX. I know most of you guys know about it. I just wanted to go over the basics of it. And then I want to talk about an entry edge that I've kind of been working on for some different strategies, but these kind of fold into the ones we're going to talk about today. And then I want to talk about a strategy that I came across. I didn't invent it, but I thought it was a pretty cool strategy. It's a 7 DTE, days to expiration. And then he calls it a break-even iron condor. So and this is in SPX again. And then I want to show you a variation of that, the one that I kind of like. And I've been running both of them, the break-even one and the what I call is kind of the 2 standard deviation iron condor. So it's more conservative. You get less money, but it's safer. And then another strategy I kind of came across on a video was a guy that's doing a 7-day put spread at the money. So what he's doing is he's selling the at the money put spread 5 wide. He's getting about $2. So his risk is 3. He can make 2. And so I'm going to share kind of my modification of that strategy, and then talk a little bit about trade and risk management, and then developing a trade plan. So, any questions? Okay, so SPX is probably one of the most commonly traded options. And SPX is the S&P cash index. It's not, you can't really buy a share of SPX, and you can't be assigned. So it's probably one of the most heavily traded of all the options. And it's on the S&P 500, and it has daily options. Every day it sells an option. Sometimes it sells 2 options in a single day. There's an AM settlement and a PM settlement once a month. So, you're never, looking for a trade to get in. One of the really cool things about SPX is you can't be assigned. Like if you trade, Tesla, and you do a trade in it and it goes against you, you may wake up the next, in the morning and get that letter from the broker that said you've been assigned 200 shares of Tesla because your option was in the money. So you can't be assigned shares in SPX. So that's kind of nice, right? If you're in the money, you don't have to worry that is my trade going to get. The other thing that I didn't put in here, it can't be exercised early. they call that a European settlement. There's American settlement and European. This is considered a European, meaning nobody can exercise it early. So someone on the other side of your trade can't say, Thursday on a Friday expiration, I want to exercise that option. Can't do it. So that's pretty cool. I put no earning surprises with an asterisk because there's things in the S&P that will have earnings. There's some consolidated companies that make up the S&P, but for the most part, you don't have to worry about a massive move due to earnings. Let me admit a few people. It's harder when I don't wear my glasses. I can't see anything.
You're right. You got it right.
Okay. So no earning surprises, and there's some really impressive tax benefits on SPX. If you trade SPX and you trade 0 day, you buy them and sell them the same day, SPX is treated 60% long-term and 40% short-term, no matter how long you hold it.
Again, did you say 60%?
60% long-term, 40% short-term.
And that's only the SPX, not the SPY.
Not SPY. Now, like the XSP here, that would any of the cash index, like NDX, RUT, all those guys are cash settled and they're treated. I forget who knows the tax code? Is it 1240 or something like that? There's a
Yeah, I think
Something about 1256.
yeah,
that's the number.
there you go. I knew somebody would know that.
That's the number.
That.
So there's a
Bottle of wine.
but one thing I would tell you though, if you're looking to get that tax benefit, you want to make sure your accountant knows that there's a tax benefit there, because a lot of them don't know.
I think they depend on the platforms like Schwab. They say, well, it'll wash it out in there.
Yeah. But anyway, that's a really good tax benefit there.
Is
So
there no wash sales on that kind of on the indexes?
I think there probably would be if you traded the exact same expiration, closed it and put it back on again.
But
But
have to be exact.
yeah, but you're not really buying shares of it. It's you're just trading options. You can't buy shares of the SPX. So there's a couple of there's tons of alternatives. There's alternatives to SPX. XSP is a really common one. That's kind of exactly equal to the SPY. It's 1/10 of the SPX. So if you didn't want to trade, SPX, you could trade XSP. Now the problem with XSP is liquidity is not near as good.
And I don't think they have weekly options, or they have weekly options, but not daily.
Probably, I don't know, but
No, they have daily.
they
Yeah,
do.
they-
Okay, so they have, yeah. So it's exactly the same. So a lot of people will trade XSP instead of SPY for the tax benefits and the fact that they can't be assigned early and all that kind of stuff. So that's and a lot of people will trade SPY, and you could do that with these strategies using SPY if you wanted to. As a matter of fact, if you were just practicing, not a bad way to do it. And QQQ, some people will do it on that. So, any questions? Okay, so get this junk out. Okay, so one of the things about this strategy, or really any strategy, is if you can build an edge into your strategy, then you have a little bit of your probabilities are a little stronger. You're not guaranteed anything, but they're stronger. So, you all know that throughout the day, like take today, for example, we started up, we went back down, we went back up, we went down, and then it took off at the end of the day, right? So that's probably the perfect example of a trading range. I mean, today, that's like a trading range on steroids. But every day you'll see, it move up and down. So one of the things that I think is important is when you're entering these trades, you want to make sure when you enter the trade, like if you're selling the put part of it, you want to sell it when it's at the bottom of that trading range. And when you sell the call, you want it to be kind of towards the top of the trading range. That make sense?
Mm-hmm.
Okay. There's a bunch of ways you can look at it. A lot of times people look at the average true range, and that's a measurement you can add to your trading platform. I like to use Bollinger Bands. It just kind of it's kind of like a giant rubber band, and it shows when you hit the top of that rubber band, a lot of times it pulls back down, or if you go to the bottom of the rubber band, it pulls back up. So you can, and I'll show you a graph that just shows that. I'm sure you've seen. RSI just shows you how overbought or oversold a trade is. And then you can also look at support and resistance levels. Like if a price is coming down to a really strong support level, then there's a chance or a good chance that it's going to hit that and bounce up, right? So that's where you probably want to be selling your put spread. And then when it goes up to the top and bounces off the resistance level, that's a great place to be looking to sell a call spread. So that's our edge, is really not to just say, oh, at 10 o'clock, I want to enter this trade. I want to sell a call spread and a put spread, because it might be at the worst time, right? It might be at the bottom, you might be in the middle. So you want to make sure that you're looking for your entry. Okay, any questions? Let me see. Sorry. Okay, so let's go to the next. Okay, so here's kind of the basics of the break-even Iron Condor. And I didn't invent this, I just saw a guy do it, and I thought it was a really cool idea. So we're using SPX again, and we're going to sell the 7-day option. So tomorrow, if we were doing this trade, tomorrow is Thursday, we would use next Thursday's expiration. Now, the only caveat being, if there was a giant Fed meeting next Thursday, you could sell the Wednesday. You don't have to, you can adjust it a little bit. Or if you're going to be gone that Friday, you could use Thursday. But it's kind of based on 7 days. And if you do it that way, you can add one on every day if you wanted to, kind of a layer them on and manage them that way for income. So what we're going to be doing is we're going to sell both a call spread and a put spread using the same expiration and the same width generally. I had one I put on the other day and somebody wrote, you did one of 5 wide and the other 10 wide. Well, that was not by design. That's and the reason you like the same width is because it kind of gives you 2 credits with the same risk. So if you do a 10 wide spread, that's $1,000 maximum loss, right? So if you do, you get $1 on each side, it's still $1,000 risk. Now you've made 200 on that 1,000. Does that make sense? And in terms of the slides, if you guys send me an email, I'll be happy to send you guys the slides. So just at the end, but you can take pictures. I just don't want you to have to worry about kind of doing everything. So we're going to sell a call spread and a put spread using the same expiration. And one of the key things that I think this is good, I like about this strategy is you enter them independently. I mean, most people, and I used to do this all the time, you would enter an Iron Condor, you like sell the calls, sell the put it on and go, right? But this is a little bit kind of has a little bit of an edge. So you
Is
enter,
is it because of the fill? I'm sorry, is it because of the fill ability?
no, it's really that when, where is the price in terms of the, the movement?
Oh,
You're gonna enter the put spread when it's kind of towards the bottom and the call spread when it's in the top. And I'll show you one that I entered today, and I'll show you the difference in the price, my entry price. But generally, you're gonna look to sell about a 10 to 12 delta. So and that is the short strike, not the total. It's just, you're selling the 12 and then you're buying a strike 10 or what? Yes, Lee.
So you entered independently, but both within the same day.
Yeah, you could enter it the next day if you wanted to. Like today, if you had entered the call spread and you didn't enter the put spread in the afternoon, you could wait till tomorrow.
since you're entering them independently, but will your broker automatically know that, you still have just $1,000?
Mm-hmm. Yeah, which is pretty cool, huh? And you could do 5 points wide, you could do 10 points, or you could do 20, whatever you want, but 10 is kind of a nice spot, that's,
Brian, I know that today is kind of, you went up and down like this, but it keeps on going up and up,
uh-huh.
So today it went up, tomorrow it went up, so where are you going to the push spread?
What am I doing when it keeps going
I
up?
can see for example, it opened at 9,000,
Mhm.
it went to 950. So, then you put a cost right there, because we thought it's an expected move is reached.
Yeah.
Okay, so then what do you do with tomorrow it went up another one.
Yeah. When it's a roaring bull market, this is probably a strategy you don't want to be doing, because this is a kind of a neutral strategy, right, Dennis?
Trading range.
This is a trading range kind of thing. However, if you are selling it when it's at the peak and you're going way above it, and you're only selling it for 7 days. So that's kind of your advantage. If you sold the call spread right before the rally this afternoon, you'd already be dead.
Yeah.
You know what I mean? So there's no reason you have to be strategic in your entry. But if it's a roaring bull market, the calls are always going to be, and you don't have to, that's the 7-day at the money put spread. That would be the one I'd be doing that all day long. And I'll show that to you later. But, and this year, yesterday was a bear market, right? Today's a bull market. So, who knows where we'll be, and I think it's kind of a trading range. I was looking at the S&P performance year to date, and it's pretty flat. It's like, it's not really gone anywhere. But, that's, this is just for education. I'm not making any recommendations that like do this trade tomorrow. And the other key thing is you want to make sure that you're collecting about the same credit on each side. Okay, so if you got 75 cents on the put side, you want to get somewhere around 75 cents on the call side, because we're going to put a stop loss that's equal to the two of them together. So if we got 75 on the put spread and 75 on the call spread, we got $1.50, right? Mm-hmm. So we would set an exit, a stop loss of $1.50 on each of those 75 cent options. So that's what the break even is. So if one side gets stopped out, you lost $1.50, but you collected $1.50, so you break even. If it fits in the, ends in the middle, you keep the whole money. Mm-hmm. So that's kind of the beauty of the break even Iron Condor. And so if it doesn't get stopped out, you let it expire. So questions?
Yeah, so call spread, you are going to close both the call spread when it reaches the 150 mark. Are you going to close both, or you are going to keep one?
Just one.
Okay, so I do like this one a lot, but that's fine. So what happens if it comes down?
Then you lost on both sides.
Yeah, that's what I'm saying.
Yeah.
Yeah. So
but the odds of that are pretty low. I mean, on today it might have been, right, with up and down, but short of that, on an average day on SPX, it's not gonna go take you out on the top and then rip down and take you out. It'll happen every once in a while.
But we have 7 days currently, it's not like the same days.
Yeah, that's, you know, a lot of people that trade the 0-day Iron Condor. It happens, right? I mean, because they can't go as wide. You know, their 10 delta or 15 delta are pretty tight.
Very nice.
So it doesn't take much for it to wipe out both sides. That's why the 7-day is kind of a lazy man's 0-day DTE. So any other questions?
For the stop loss, is that safe to keep open for like the whole 17? Cause I know it's like, a lot of times I trade like volatile stop. So like, things market opens and options and like volatile swings.
Yeah, I mean, I would put it on it, you know, if I was doing the pure, break even, because what you don't want to do is just ignore it. And then, you know, you go to lunch or something and then you come back and now it's, instead of $1.50, it's $2.50 kind of thing. So I would put it on, but if it's I mean, this isn't really a super volatile movement. And again, we've got like 7 days to, now if it was the last day, I'd probably be watching it a lot closer. So, you know, and you could, and there'll be some alternatives. You could always close this, you know, like at the last day, and you have, you know, 10 cents of credit left. You could take it off. Just take the, you know, pay the 10 cents and you don't have any risk. Okay, so here's just a quick example. I think this might have been the one I did today. So, SPX was trading at, actually this is not, this is all at one time. So, right about 6,800 is 67.96 is where it was trading. So if I went out and sold a 10 to 12 delta strike, I would have sold on the put side 6,600, 65.90. So I mean, we're like 100 and almost 200 points out of the money. So that's pretty far, right? I mean, we're going to need it, but it's a long way. And so we collected 90 cents. And then
And you were exactly 7 days at that point?
7 days, right?
Good.
And then on the call side, I sold a 69.90, 7,000. So again, 100 points out of the money. 200 points out of the money. Okay. And I got 90 cents for that. So I got $1.80 credit for that Iron Condor.
And
So
the delta on the call
About
side,
10 to 12.
same.
Yeah, and what I will do if the call side was, you know, the 12 delta was $1.50, I just push it up. I want to get about the same credit, you know, because
You are not looking at the expected move on this rate.
I am looking at the expected move, but it's going to be well beyond that. So, and I have the alternative looks at definitely builds around the expected move. So the total credit would be $1.80, $180, my maximum risk. If I just if this thing just blew up and I didn't do anything about it, I would lose $920. The most I could lose per contract if I just totally didn't manage it. But I would be setting an exit order at $1.80 on each side. That makes sense? So that if the call gets challenged and goes up and takes me out at $1.80, then it's going to be a break-even trade, unless the thing rips down and takes me out there. But you'd have a stop loss on that end, on that spread as well. So you could lose, you know, on both ends. Probably rare, I mean, but it will happen.
Also let it expire.
Hmm?
So you only lose on one if you let it expire.
Well, you would, I mean, if it didn't,
Unless
if it
unless
didn't
it-
stop you out, yeah. And that would be a massive move, right, from
Yeah.
6,800 all the way up to 7,000, and then come all the way back down to 66. That's a 400-point move in a week.
Just to tell you, I sold or wholesale a money manager that did iron condors. And what he didn't do was what you're doing on the hedge. He didn't do that. So you make money, you pick up a lot of weekly premiums,
Mm-hmm.
but then in one bad day, oh my lord, man, that thing would, you get crushed.
Yeah.
So what you do makes a lot of sense, Brian. You put that stop in.
Yeah, you want to put, even if whatever you're trading on it, you just want to have like a crazy stop, if nothing else, just because,
As protection.
I mean, all you got to do is look at yesterday and today in the market. That, if you were trading 0 DTE today or yesterday, that would not be a fun kind of trade to be in. So that's kind of just a real high level example. Does that make sense? Y'all like it? Now the downside of that strategy is going to be, you're going to have a lot of days where you break even. You know what I mean? Like you put this trade on, watching it, one side gets stopped out. And you're going to be like, oh, that's boring, right? I didn't make anything, but I didn't lose much. You might lose a little based on slippage, but it's one of those ones, I was kind of calculating it. If you did this trade 5 days a week, and one day out of the week you got the 180, it's still a heck of a return. But you just have to know that if you're if your psyche is that I've got to win every day, this would not be a fun trade for you. It's an income trade, and it's safe, so you're going to get stopped out more because it's a pretty tight stop. Two times that what you received. So that's my caveat on it, is that if you're going to get stopped out 3 out of every 5 days, and you're good with that, then it's a great little strategy. I would probably do it in conjunction with some other strategies.
You're doing like daily, weekly out, daily?
Yes.
Done.
And you don't have to, but
Usually 7 days, so Monday,
Yeah.
Monday, whatever.
Monday, Tuesday, Wednesday, Thursday, Friday.
Then Tuesday, you do
I do it for next Tuesday. And the only difference, Gil, is that if there was a big Fed meeting on Tuesday,
you avoid that.
I would either avoid it or I'd use a Monday again. That kind of thing. There's nothing against you doing it 6 days. Or if you were going to be going on a big trip and you wanted to get them all out of the way, you don't want to be. If my wife was here, she would say, "You should listen to that, brother." Isn't that right, Peter?
Yes.
So anyway, here's a couple alternatives to this strategy. So, and then you could probably come up with a lot of strategies or little alternatives yourself. But the one is, instead of the 10 to 12 delta, use that 2 times the expected move. That gives you more room on either side, as opposed to the 10 or 12 delta. Because just, thinking out loud, that 10 to 12 delta, 80 or 90% of the time, you're good.
Yeah.
But 10% of the time, you're going to be, it's going to be in the money, right? So you have to be aware of that. And even though if I say 10%, it's actually more than that, because if it starts getting close to your number, that 90 becomes $1.80 pretty quick. So it doesn't have to get in the money. That's another thing. You might still be 50 points away from your short strike and it'll stop you out. So just keep that in mind. You could use longer or shorter expirations. Like you could do monthlies if you wanted to. Nothing, you could start with 30 days and go out from there.
There's 2 days daily, but going on.
Yeah, whichever way you want it. You could go out 2 weeks if you wanted to. I haven't done that, but it's definitely, I wouldn't do 0 day myself, but you could. The other,
No guts.
no guts, no guts.
What kind of a return are you targeting for, or does it was there,
I'll show you, but yeah, I think I actually did have it in
Yeah,
there.
about 19%.
19%. It's pretty good.
Yeah.
But keep in mind, there's a lot of days you zero out of it, you
Yeah.
know, it'll look like a
Yeah,
like a
so
scratch
19% goes down. You
Yeah, but it's still
average.
pretty good if you just kind of take that one day and divide it by, you know, whatever, 900 times 5, it's still a pretty dang good return.
Yeah. Okay.
So anyway, so
Uh-huh.
you could set the stop loss at like 2 times the credit receipt. You know, instead of getting, you know, 90 cents, you could go out and say, I'm willing to take a loss
Mhm.
on the trade for more room. Guts, right, Dennis?
that's the.
And I actually like that better myself. I'm willing to take a little risk and have a higher win rate. The other thing you can do is, you know, this is kind of built on letting it expire at the end of that 7 days. You could always take it off early. You could say, I want to take it off when I'm at 50% of the credit receipt. You know, at the last day, you could close it out. So lots of alternatives in terms of how to manage or alternatives to it. The other thing you can always do is adjust the strikes while the trade's open. You know, like the trades, like say I put the trade on today. Today's Wednesday. So my thing is next Wednesday, I can roll my calls and put options up or down if I wanted to. I don't like to do that personally because it's just a lot of work. But you would not do that, right?
No.
Okay. But you could. That's an alternative. You could say my call spread is getting challenged. My put spread's making a lot of money. I just scoot them both up, move both spreads up. You know, if you can do that for our credit. Okay. Any questions?
I'm just curious,
Mhm.
if, once the trade is on, and if the call spread is challenged and you get stuck out,
Mhm.
and do you not put another call spread further out?
I
So
don't.
you know,
Because I'm, you know, theoretically, I'm just putting another one on the next day. And if you do that and you get stopped out again, then you kind of, it's not a break-even trade anymore. But you could. I mean, there's nothing wrong with it rips up, it takes you out and comes back down. You could put another one on.
Now, what do you mean by adjust the strikes while the trade is open?
So like say, you know, we had that put spread and the call spread, right? And say it goes up and your put spread's making a ton of money, right? And your call spread's getting challenged. You could adjust both put spread and call spread up to make it more where the price is more in the middle.
So you're basically adjusting your spreads in accordance to the
Yeah, you just,
price.
you know, like if price is here and you just move it up or move it down.
Kind of like a trailing stop.
It is, but it's a lot of work, but you could, you know. Like, you know, I had one where like the minute I put like within an hour I put it on, it was already like at 80% credit capture.
Yeah.
Well, that one might be one you just say, well, let me just move it up and get more money kind of thing.
But then you did a debit on the other one.
If you adjust both of them, right? So, okay. That answer everything? Y'all like it?
Yeah.
You're probably already thinking of alternative. If you're like me, you're thinking, okay, how do I
How do I
change
tweak it?
this to make this mine? Okay. Let me see if anyone had a
How
question.
often did you get hit, being 200 points away or your 10 delta? Did you say that? How often you got?
It doesn't have to go through all the way up to the point, even if it moves like 50, 60 point, you will be losing money.
Yeah.
Yeah, it doesn't have to go to all the.
It doesn't have to go
Right.
all the way to the strike, that's for sure.
Right. So, yeah.
But it will challenge it, you know, when it moves. So that's the really good reason why you'd want to have that stop in there, right? Because it can, instead of being $1.80, it could go to $2.80, and then you got a losing trade. You know what I mean? So that's kind of the idea. If you do the trade and you set that tight stop loss, there's good and bad to it, right? One, it saves you from losing a lot of money, but it might take you out early. earlier than you'd want to. Y'all will be saying, I can't believe Brian told me to put it here, kind of thing, because I'll get stopped out. So let me just, a couple of questions that were in here. My email address. So it is Brian, BRIAN Terry, TERRY, CFP, Charlie Frank Paul at Gmail. And Pat had a really good question. It's a set and forget trade. It can be. If you want to just set the stop loss on it and go about your business, yes, it will execute the stops and that kind of thing.
Brian, can you please repeat your email ID?
Sure, it's brian.terrycfp@gmail.com. Okay. Has this been helpful so far? Okay, so here's the one I kind of like.
That's the one they did, my money manager did.
The two standard, okay, yeah. So what you're doing here, the only real difference is instead of just using 10 or 12 delta, I'm looking to see what's the expected move over that period of time. So 7 days, and we'll look at an option chain later, but it'll say it's 100 points in that 7 days, plus or minus. So you want to set your shorts 200 points away. So now you've got your strikes are 2 times the expected move. And so that will give you more protection, a little bit less money. So it's still a really good return. It's just not as juicy as the 12. And I'll show you a spreadsheet that shows both of them on some of the ones I've done.
And with this, you have less potential of getting your stop. Yeah.
Yeah. You should be able to have less stop outs. Now, and then you can set your stop loss at wherever you want it. You could do 2 times like the break even, or you could do, well, I'm willing to take a one-time loss, 1 times my credit loss. So if you collected, the other one you were getting about $1.80, this one you might get $1. And so you're willing to say, I'm willing to risk $1 to make $1 kind of thing on the trade. But you come up with, what strategy, and for me, it's still a work in progress. I'm kind of playing around with it. Same thing, you enter each side separately. You don't go at, 10 o'clock, I'm entering my Iron Condor. And then you would, trade management, same thing. You're going to set your stop loss or your exit level, that kind of thing.
What I noticed, I traded today, the SPX. I did a put spread, about 200 points away, to about 3% from where it's at. And it fluctuates from 10 cents to 15 cents. So it does this constant back and forth. It's hard to pin it down, but it wouldn't fill that quickly. And I noticed that plenty of volume and plenty of interest at those strikes. So I didn't understand why it wouldn't fill.
I think SPX, even though it's liquid, it doesn't fill instantly all the time. So, you just have to, put your trade on, and then you won't want to go get a cup of coffee or whatever. But it doesn't always, sometimes it does. Sometimes the minute you hit the enter button, you get a fill. And then other times it might take 5 minutes.
And I thought it was because I was so far away that it
could be. I mean, the further your strikes are away, the probably less open interest.
Exactly.
So that's another thing. When I'm looking at 2 times, so if I go out that 100, 200 points, I'm looking, okay, what strikes around there have the most open interest? So you want to make sure you don't pick, if it says 80, 8,200, and 8,205, that's all the open interest. You want to use that one.
Yeah, and you can get the same credit within 20 points further out. actually, sometimes.
You can. So you just have to play around with it. And I, if I was, trying to get $1 for it and it's, at 95, I just lower it and get 95 but that's just me.
Yeah, I'm not very patient, I need to say.
Yeah, I just,
Just the security.
I don't know why,
Trying to
I've
save
got,
pennies on what is it? Trying to save penny on a tractor?
yeah, I have a buddy that's like, there, won't give me my money. And I don't think it's anything personal. But anyway, so before I go this is that next strategy. So I'm going to show you a couple of spreadsheets, if that's okay.
Okay.
And I'm going to stop the share so I can share it. Okay, so let me find the spreadsheet first. Okay. Okay, now I gotta share. Okay. Okay, perfect. Okay, so this is kind of my campaign on this strategy. And so I wrote down, the date that I put the trade on. Actually, let me just do this. This is the one I did today. So this one is, so it's at 121, and I did the call spread and the put spread kind of separately. So, and I'm not sure which one I entered first, but the price of, I think I did the call spread second, just because I did it at the end of the day after the big run up. So the price of SPX when I put the trade on was 69.01. So it had already kind of popped. Remember, it kind of went the last whatever, probably 2 hours or an hour. And I sold the 70, 50, 70, 60. So
Somebody's marking it.
hey, that's good. Thank you, whoever did that.
And that's based on a 10 to 12 delta?
Yeah. So it expires on the 28th, and I got 70 cents for it. So earlier in the day, we were down to 68.22. So you see, that was 80 points difference in where the price was. And I sold a 6,600, 65.90, and I got 75 cents. So I got $1.45, and risk was $8.55, and that's just simply taking $1,000 less my credit.
And that's one contract.
That's just one. Actually, this one I did two because I'm going to start doing
Other.
each exit, but that's on one price per contract.
Awesome.
And that would be like a 17% return if it expires in 7 days. So not bad, right?
The true range is maybe we expect that the FX will not move more than 200 average, or like up and down, like something like that,
Yeah.
or it is sometimes.
You know what's really funny? Yesterday, I was putting a 7-day trade on, and the expected move maybe 100. And then Trump tweeted, and that 7-day range went to like 180.
Yeah.
Like in like minutes.
Yeah.
So it'll move. I mean, and I'm not being political. It's just that's what the effect on the market is. And so that's a trade I put on today. So I don't know if it'll work or not, but that's my trade. So here's some trades I finished already. Just and again, I'm just experimenting, so it's kind of a lot of different things. So the first trade I collected 95. I closed it for 20. I think make this a little smaller.
Oh, another ROR.
100.
Yeah. So
So squeeze the columns a little bit, maybe.
there you go. Okay. So that was, and there's actually a day, but you can figure, I mean, so it was, somewhere between 18 and so 12%, one was 32% because I closed it for $5 at the end. Yes, Peter.
You may have covered this already and I just didn't catch it. How do you decide how far between the two trades you put them on? Do you watch, what are the clues you're looking for that?
I mean, how do I figure out the strikes?
Yeah, yeah,
Yeah, I'll show you it on a graph. I
Okay.
mean, a chart, so we can kind of,
okay.
but what I'm looking for on the chart is like on a Bollinger Band. I want it to be hitting the bottom of that Bollinger Band. And then I want to sell the put spread below that. And then when it moves up, like today, when the market ripped up, I remember like the last, I don't know, 30 minutes or an hour, it just pounded higher. And then it kind of started to, that's when I sold my call spread.
Okay.
And if I'd sold my call spread before all that, I'd have been dead in the water, right?
Yeah.
Okay.
So that's
Or
kind
be close to the edges of the.
of, and you don't have to be perfect, but, and you won't be, because you think it's done and then it goes up another, another push higher. But, so that's just the spreadsheet of my break-even Iron Condor. So, and most of them, let me just see if I can get the number a day. Make this smaller. Okay, so that would be the number of days I was in the trade. Some of them 7, some 6, some 3. So, and again, it's just more of an experiment than anything else. Does that make sense? What do y'all think? You like it? So here's my 2 times the expected move. So this is a little more busy. I don't know why I ended up doing it in a different format, but it's the same kind of trade, except for I calculate what's the expected move. And then, so you're not getting as much, like instead of getting 16% or whatever that was, you're getting more like, 6 to 10%. Still not bad in a 7-day, like this one was kind of a fluke. It was 1 day. But everything else has, been, 4 to 7 days. Like today I had one that was, pretty far out of the money and I just let it all expire. So that one was a 10% return in a week.
This is on the 200 strategy, the 2 times.
This is the 2 times, yeah.
What type of credit you are getting? What type of credit?
Oh, yeah, the total credit is probably somewhere, somewhere between, I don't know why this is so low, but around $1. Yeah,
Two sides are one side.
2 sides.
Two sides one side.
Mhm. I think this one was like a 5 line, but anyway, but $1 on a 10 line.
France, you usually buy stuff or buy stuff.
You do. That's the best. That is pretty much the only way you want to set a stop loss on these guys. Does that make sense to everybody? A stop loss. Okay. I don't even understand all of it, but it's, what it does is it kind of, if you hit that stop limit, then there's a limit so that it takes you out, kind of thing. It doesn't, like a market, I'm sure, maybe I'm the only one that set a market order and it hits $1 and you get filled at $1.50. You're like,
Yeah, you don't.
but if you do the $1 and $1.30, it's gonna limit.
So you're doing a buy stuff.
I am for my stop loss, yeah. And I haven't really had anything hit yet, but which is kind of crazy given the last couple of days. But so that's the 2 times the standard deviation. So you could see a little bit of difference, right? But still a pretty good trade.
So in a week, I suppose you do 1 each day, right? What is your average return on all 7 trades? If you were to average that out.
Let me just do these because the first one was kind of a weird one. 7%.
Okay, that's pretty good.
Yeah, not bad. Okay, so that makes sense. Okay, so let me go back to the other strategy. Stop. Share, and I'm going to go back to the PowerPoint if I can find it. Oh, there it is. Okay, so that is the Iron Condor. I've done that many, many times. I appreciate Hmm. You must have been in the audience once where I didn't do that.
I'm an IT guy.
Thank you. Okay, so let me do the slideshow. Went too far. Okay. Okay, back on track. Oh shit, yeah. Okay, thank you. Okay, so this is a different strategy. So we did the Iron Condor, right? And so this is a strategy. There was there's a really good website. You ought to write this down. It's called Theta Profits. You ever heard of it? You saw me. Other than when they interviewed me, it's really good. But it's a guy out of Norway, and what he does is interviews traders. And
We should call it again, data profit.
Theta Profits.
Data, in Greek.
He's-
Two words, yeah. And you had to go to Norway?
I did not have to go to Norway, but
Darn.
the guy that runs it is a guy named John Sanderling or something like that. Super nice guy. But what he does every week is interviews a trader. He just says, "What's your strategy and what are you doing?" And some of them are like way over my head. I'm like, I'm not doing that one. But they had this guy, and it wasn't but a few weeks ago. This guy, I don't know if he was in Iowa or something. And he had a small account. Started with like $5,000, and he grew it to like 17,000 in like a short period of time. And I'm like, okay, that's got my interest, right? And he has a 71% win rate, and he's done really well. So that is kind of the basis of where I stole this trade. And so anyway, so it's the 7-day at the money put spread. So this would be, to your point about a bullish market, this is a bullish strategy. And so what you're going to do here is you want to be selling a put spread when the price moves to the bottom of that range. And then you're selling a 7-day, your strike is close to exactly where the price is. And you can do 5 wide, I do 5 wide, you could do 10 if you wanted to. If you do 10 wide, you won't get it a 1-to-1, close to a 1-to-1 risk reward kind of thing. So you get more credit, but you have more risk. So if you do the 5 wide, and you set the short put close to where it's trading, and a 5 wide right below it. So you should be able to collect around $2 for that spread.
Is this the SPX again?
It's still SPX.
Weekly or what?
7 days. And so you're getting $2 on a $5 wide. So if you put it on and you just forgot it, you would either make $200 or you'd lose $300. So that's kind of the thesis of that trade is if usually in a bullish market, the market is higher 1 week away. A lot of you guys know Eric, who's a member of this group. He does a lot of SPX trades, and he does a lot of research on, he calls it the weekly triumph rate. And he'll say, on this Monday, there's a 70% chance it's going to be higher in 1 week. And it's almost always at least 50% or higher. I mean, it's very rare that in a bullish market that it's a 30%, chance of it going up. So that's kind of the thesis. So if you get $2 and you risk 300, your maximum return on risk is pretty impressive, like 66%, 66%, 66%, 66%, 66%, 66%, 66%, 66%, 66%, 66%, 66%, 66%, 66%, 66%, 66%, 66%, 66%, 66%, 66%, 66%, 66%, 66%, 66%, 66%, 66%, 66%, 66%, 66%, 66%, 66%, 66%, 66%, 66%, 66%, 66%, 66%, 66%, 66%, 66%, 66%, 66%, 66%, 66%, 66%, 66%, 66%, 66%, 66%, 66%, 66%, 66%, 66%, 66%, 66%, 66%, 66%, 66%, 66%, 66%, 66%, 66%, 66%, 66%, 66%, 66%, 66%, 66%, 66%, 66%, 66%, 66%, 66%, 66%, 66%, 66%, 66%, 66%, 66%, 66%, 66%, 66%, 66%, 66%, 66%, 66%, 66%, 66%, 66%, 66%, 66%, 66%, 66%, 66%, 66%, 66%, 66%,
But I think what he was doing, he was waiting for the last half hour.
Yeah.
Right,
So
that's
this
what-
is actually a little bit different. Remember, we talked about the edge, and trying to say, I'm gonna put this trade on, I'm just waiting for it to, and we'll show you a chart that kind of shows you how I look at it. But you guys might be even better at it. So that's the at the money put spread. Make sense? Okay, so this is a quick example. The SPX was trading at 67.96. I sold the 6,800, 67.95. I collected $1.90. So I sold the 6,800. I bought the 67.95. So that locks me in that no matter what happens, the most this trade could ever lose is $300. Can't be assigned early. You can't, that kind of thing. So that's the kind of the example.
And you wait till expiration, you don't close, you don't have any stop loss, nothing, it's just like a 300.
That I'm working on that part because I mean, what I'd like to do is on the last day, I want to look at it and say, I'm at, I got $2 or I got $1.90 and I've collected $1.80.
Yeah, you're
No, do that.
And I just get out,
Move,
right?
yeah.
Or if there's something weird coming up, like I think there was, I forget exact, something came up and I'll show you my results, but it was like, I just got out
Yeah.
because I think it was the Supreme Court. They were saying the Supreme Court decision on tariffs were coming out and I said, oh, I'm just getting,
Or like labor results or something like that.
Whatever,
that same
yeah.
day.
But you could, I mean, there's nothing, if you thought this, if you checked what your expectancy was on this trade, you could just say, I put it on, and if I win 60% of the time, this is how much money the trade's gonna make. I haven't done that yet, but I think that's where I will probably move to. Because you just never know, right? I mean, except for if I'm, the last day and I've collected everything but 10 cents, I might take that 10 cents off. Go home early.
You could dial down the spread further down if you want to be more conservative.
You
right?
could,
Yeah,
you could. Just a
not
different
chance.
strategy. Yeah.
Same idea though.
Yeah, you just want to say, okay, I don't want to sell at the money. I want to
Yeah,
sell
further
20 points lower,
Yeah.
30 points lower.
And
Yeah.
then do the same $5 credit or
You
whatever.
could, yeah, you sure could. So but the coolest part of this strategy was, it's like, wow, you make 2, you risk 3. That's pretty good in credit spread trading.
Yeah, sure.
And then add in the edge where if it drops
That's right.
into the bottom of the range, it doesn't mean it's going to work. It just means you've improved your odds or your probability. So,
That's cool.
so anyway, so the 190 divided by 310 is 61%. Now you're going to lose some, so
That's what you have to average in. is
you do.
that loss.
What you have to do is if you're going to just put the thing on, win 2, lose 3, you have to say, what's my expectancy? If I think I'm going to win 60% of the time, then you just run the numbers, right? You win 200, 60% of the time. You lose 300, 40% of the time. How much money is a trade going to make? And the guy that did it, just so you in the video, and you could watch it, it's on that Theta Profits. It's I think he said its win rate's like 71%.
And did he say how long he was doing that for?
He hadn't been doing it really, really long.
Because
So
obviously the more sampling you have, the
yeah,
more
yeah.
that.
And what I would just, my personal thing is, if the market is not in a bullish market, I wouldn't do this strategy.
That's
So I would probably say if, I would look at the 10, 20, 50-day moving average. The price would have to be above, the 10 would have to be above the 20, price above the 50 before I put the trade on. So yesterday when it sank, I said, oh, I won't be doing any at the money put spreads. And then today it's back into, but who knows what it'll be tomorrow. But anyway, so that's that.
How did you do your risk calculation on that?
Sure. Okay. So it's a 5 wide, right? So you got $500.
Okay.
And then I collected 190. So you take 500 less 190. is your 310.
Okay.
Make sense?
Yeah.
Okay. Okay, just a couple alternatives. You could use longer or shorter expirations. You could say, I don't want to do 7 days, I want to do every 14 days. You know, that will give you more room, you know. You could trade a wider spread. You can set up $5, you can do $10. You can exit at a certain, you could say, I want to get out if I get 50% and then I'm done. And you can set a stop loss to say, if it gets to, I got $2, so if it gets to $4, I want out of the trade. So then you're at a 1-to-1 risk reward. So whatever, you know, you feel comfortable doing, there's lots of kind of versions or changes you can make to the strategy. And again, you could trade it in the SPY, the Qs, XSP. I never traded XSP.
Is there an inverse when things are going in the bear side?
Probably. I haven't seen that video yet.
Because,
too.
yeah, why just make it when it's going up?
I mean, you know, I can answer for Eric. What he would say is his back testing wouldn't support that. Mainly because, well, what happens is in a bear market, you're selling call spreads, right? It doesn't, you know, how long do these bearish trends last? I mean, not very long, right? I mean, they might be if it's 2 weeks, we're like really grumpy, right?
Right.
So, you know, that's,
No, but you would still do puts, but you would buy the inverse of those tickers, is what I'm saying. Not do.
oh, I
calls.
don't know.
That's what I'm
That's a
saying.
good idea.
But you're still doing puts, you're just
I
buying
think it's
it.
the same thing though. If
Yeah, it
if
would
you're
have a
doing an
short-
inverse
short.
and the market goes up, it's gonna get crushed.
Cool.
But, you know, if it was that kind of market, I'd be doing the Iron Condor.
Right.
So, iron flies like Dennis does. So that's some alternatives. Like again, it's kind of like a work in progress. Just in summary, I think both of these strategies have a lot of potential. They still I need to work through all the things. The ATM put spread is a bullish only strategy. You wouldn't want to do this in a down market. The Iron Condor is more of a neutral strategy, but risk management needs further development because I think, you know, I haven't done the strict break even just because I know I don't want to lose 3 out of, you know, 5 times or not lose, break even. And so I'll be continuing to test these strategies. So questions? Which one do y'all like better? Or either? Iron.
The 67% defense.
You like the put spread? You like okay. I think I can show you. Would y'all like to see my at the money number so far?
Yeah.
Let's see if I can find it. They're not as impressive.
But you have less samples.
Well, the problem is,
Not been a bullish market necessarily.
well, the last 2 days were kind of, yeah. So anyway, let me see if there's any questions here that I did. What's my favorite bear market strategy? Probably if it's really bear, I'm just sitting in cash. And then let me see what else. Market goes up more than go down. Yes, that's true. So the put spread on the inverse may not be, I agree with that. And then, do you use the expected move calculation each day? Yeah, I'm looking, when I put the trade on, I'm looking at what the expected move is. I don't change it after it's on. Let's see. I think
You get the expected move from Tasty,
yeah, I can show that to you.
or you mainly do it?
I just take it,
Money.
I don't. I just take whatever Tasty is.
Tasty say,
Mhm.
because Tasty and Think or Swing, they have.
They're different, yeah.
Yeah.
So,
Yeah.
Oh, I didn't know
yeah,
that.
yeah.
Which one's more conservative?
I think Think or Swing.
Think or swim, yeah.
Good.
Yeah, so here's,
At least it's vegan.
Exactly. You know,
so
that's-
yesterday was a bad day for this at the money strategy. Imagine that when the market tanked 2%.
Yeah.
But so I was doing really well on the first, whatever, 3 or 4. And then I lost on the second, the last 2. And I didn't put another one on yet. So I didn't calculate it.
Yeah, your averages.
Yeah, I didn't want to look at how. And so, I mean, counting those 2 stop outs, I lost $75 on whatever those 5 or 6 trades. So not bad considering the 2%.
You're just setting it and letting it go, basically, in this trade, right? More or less.
Well, let me see. On the one I traded, I got out a little early. The
Okay.
risk was 310. I got out at 190. This one I got out at the full stop loss because I couldn't get out early. I mean, I was trying to get out for like, not have the assignment costs kind of thing. So but it wouldn't fill, so I just let them have it. But the good thing about that, even though it was in the money, I didn't get assigned because it's SPX.
Right.
Like if you had done SPY,
But they do charge you the $5.
$5, yeah.
Fee.
yeah,
They still have.
that's what I was trying to get out. I was trying to get out to save my $5.
When they show up like after 1 or 2 days.
What the fee?
Yeah.
Oh, I've never even seen it, but I know they're charging it. So
So right now it's negative. It's not working
it isn't working.
right now.
And-
And it's very few samples.
It's right. And
Yeah.
keep in mind, this was a day the market went down 2% in one day.
Sure, yeah.
So
Bad timing.
yeah, it was bad. But I think there, if the market, if price, the 10, 20, 50 is a good a good time to be in the strategy. Because the payoff is really good, right? And I would probably say 2/3 of the time we're in a bullish market. So that's when you want to play with this. Let me show you, I think, Peter, you asked for about the chart. So let me bring up a chart. Let me stop my share. And okay. Okay, so this is I don't want to do daily. Let's just do 10 minutes just to, okay, so let's just go. So you can see like when the market goes up here, right? This is where you want to be selling your call trades. And this is a good 10-minute chart. I usually do 5 minutes, but
10-minute chart. Okay. Now, what I was gonna ask is, what were your Bollinger Bands set at?
2 standard deviations.
2 standard deviations.
And then, when it comes down, that's where you want to be selling your put spread. And it's not always going to work, right? You sold it here and it moved lower. So, but you've sold it way below, and you've got a week time for it to, settle in that range.
And you only base it on your 10-minute?
You could do it whatever you want. I actually look at a lot of times I'll look at it at the 5 minute.
Okay. Yeah, because if you go to 1 minute, that's not really
1 minute would be too
specific.
like this is what happened today.
Mm-hmm.
It's like, okay, Trump said no tariffs to Europe. Boom, it went up, right? It just ripped higher. But then it kind of leveled off, right? And it kind of said, okay, maybe there's more to the story, right?
We have a temporary plan or something like, we have a concept of a plan.
What I did there is that's where I sold
Thinking of a plan.
that's where I sold my call spread up here around 7,000. Remember on that spreadsheet? So,
So you saw it leveling up, that's what you did.
yeah, and I would have waited the next day if it just kept going. I wouldn't just force it. There's no reason you have to put both sides in on the same day. Like I've done it before where it's like, okay, I've got 2 put spreads and I'm waiting for a call spread to add to them. That's, you can do that. You just want to use the same expiration, so now you're only selling a 6-day kind of thing. Okay.
The RSI, you go RSI 2 here? Or no?
I do sometimes, like if the RSI is, I shrunk it down a little bit just so to get the, you know, like if you look here,
Mhm.
the RSI is like off the chart, right?
Overbought.
That's kind of shows, that's more confirmation that, and you're not trying to like nail to the tick. You're just trying to say, at what point do I have the best odds to sell that call spread? Like not down here, right? You don't sell your call spread down here. You wouldn't sell a put spread here.
Right.
So that's kind of the whole edge kind of thing. So, any other questions? Has this been helpful?
Oh, yeah.
So that is, that's all I got. So anyway, let me see if, anything else?
Money management.
Okay, here's a spreadsheet that I've been playing with, and I haven't, finished it yet, but it's one of those things where you could say, I really like, you know, the SPX trade. And you calculate, you know, an expectancy, and you say, okay, how many contracts would I do in a week? And you calculate what's the expected, you know, so you can work through it like that. You can kind of say, I'm gonna do 10 of these, 9 of these, that kind of thing. And then you could calculate, okay, how much money is that going, what kind of expected return would I get based on how you calculated your expectancy. That's when I'm like really bored. I'm doing expectancy spreadsheets.
Right. Brian, with all the different strategies that you have,
Mhm.
what is your daily effort? I mean, what do you usually focus on? What's your go-to? What's your go-to?
You know, I'm like an ADD. I'm like try a little bit.
Oh, yeah.
I like the poor man covered call, you know, diagonal call spreads. I like those a lot. You know, one strategy we've covered in here in the past is, I call it the Igor. It's a 45-day 10 delta on the SPX. And you get about $1.30, $1.50 on a 25 wide, nothing. And the guy, Igor, who does the trade, he's been doing it for like 5 or 6 years, 95% win rate. And I've never lost on, you know, and I've
been doing it about 5 months. I haven't had a loss yet.
yeah, I mean, it's like you're like 500 points out of the money, you know, and
Even today, I would be worried.
you know what? I don't even, like yesterday when the market was tanking, if you look at the profit, you know, your open profit and loss, it looks really ugly.
Yeah,
But you're still 400 points out of the money.
Yeah.
Right. So
And you let it expire.
I'll take them off at 50%.
Yeah.
Yeah.
mentioned that before.
Yeah. Just because it does tie up a lot of capital.
Oh.
Frankie, I don't know the Igor trade. Can you explain that?
Sure. Yeah, I'd be happy to. Okay, so that is SPX.
Right.
Go out about 45, 50 days.
Okay.
And I sell around a 10 delta,
Okay.
25 wide. So, you know, your risk is going to be 2,500 less the credit you've taken in. So, you know, say you get $1.50 in credit, you are making, your risk is 23.50. But, you know, if you say, okay, and when I was last year, I was probably doing tranches of three times a week. So you make like 380, sometimes 2 in a week, and it's really a boring trade, and it makes a lot of money.
I like those.
Can you label that one, Ivor, when you send it out?
Sure.
Yeah.
Actually, I don't put that a lot in the group, but I can, yeah.
Thank you.
And, we call it the Igor.
And what's,
I'm sorry.
and what's the rate of return for 45 days or for as long as you have?
I'll show it to you. Here's my Igor. So here, this is like last year, it was like 3.8, 2.7, 14 days, something like that.
So for about 2 weeks, give or take.
Yeah, you're not in the trade for very long. And then here's some just monthly numbers. So June, it was, 4%. And these are annualized, so like 100% annualized return. So,
Double your money.
so it's a great little strategy. I put that one on all the time. Bear market, good market, it doesn't matter because you're just going so far out of the money. So that's the Igor. So
I like, the only time I did it was last April.
Oh, that didn't work.
okay, someone had asked about the poor man covered call. Be happy to
US.
So the poor man covered call, that all that is kind of like if I'm bullish on a particular stock, I'm going to go out and buy a call, usually between the 50 and 60 delta, and I'll go out about a month and a half, 2 months, and I will buy that call. And then I will immediately start selling calls against it around a 20 delta. And if it goes up and hits my short call, I get out of the trade. So, like I think I closed a couple not too long ago where it was like, 25, 30% rate of return in, 2 weeks. Now they don't all work because, if the price goes down, the trade's going to lose. But by selling the calls, you're offsetting. And theoretically, like I do a leap trade where I'll go out, I'll buy like a 1 year call. You could write weekly calls against it and totally collect credits to wipe out the cost of that thing. So that's the poor man covered call. I hate that name because it's not cheap. You know what I mean? It's not. I mean, you could pay $5,000 for a call on a higher price stock. So I hate the name. I always call it like a leveraged covered call. It's my favorite version of that. Let me see.
Again, you're using the SPX.
No, I would do that on individual stocks or ETFs.
Yeah.
You did it on Spider, right? You were doing it on Spider quite a bit?
I could have, yeah. So here's someone had asked about the expected move.
Yeah.
Okay, so here's like, this
Yeah.
is the expected move here. 96. And before the market went up, it was probably 150. So that's that. So,
But I think somebody was asking about, that was one.
well, I
one
didn't share that.
parameter,
I
but
wanna tell you what I see, think of it.
Okay.
Is this,
SPX, right?
this is real time right now?
Well, it's market's closed,
Yeah.
but
It should freeze it, yeah.
let me,
SPX for 28.
yeah.
We have it there.
Uh-huh.
Yeah, it's more or less thing, 107, 108.
Okay. Now one trick you can always do to calculate a different way of calculating.
Yeah, that's
If
what I was asking.
If you go to the at the money strike and add up, I don't know what's the at the money strike.
Yeah.
68.75. So if you did this one and this one,
Yeah,
they're saying it's 100.95. So that's a different way of
Yeah, the
calculating
value.
the expected move.
But I think if we go to the 10 delta and on both sides, I think that was one of the questions too. Where does it put you on the strike?
On the expected move?
No, using the original strategy where you're going to 10 to 12.
Oh, okay. Let's just do that if y'all want to. So here, let's just do 67 and then go up on the top. Okay, so that would,
Oh, there's the 10. Oh, I got you.
yeah. So it's, like Tasty and their chart, you see this little brown line?
Yeah,
That's the expected move.
Ah,
Yeah. Did y'all know that?
That's super easy.
The other thing is you see these dotted lines, that's one standard deviation.
Yeah,
So-
that is not there in Thinkorswim. That is good in Tasty, I think. That is not there in Thinkorswim.
Okay,
No.
yeah.
No, it's not there.
Thinkorswim has a lot of really good things,
Yeah,
but
it looks like it. Like everything's also, I mean, we can look at it all the time.
yeah.
Tasty trades still there, I mean, in the ticket itself when you're looking at the thing. But Thinkorswim don't show that.
Okay,
For example, NVIDIA.
right.
So it will show you when if you go to the NVIDIA, it will show you the
Okay,
earnings date.
Yeah, yeah. And then someone asked on the poor man, do I roll out the shorts if they're challenged? Sometimes, yeah, just, push it up and get more credit kind of thing.
And do you also roll the long end?
I don't generally, just,
Any reason why?
well, because I want to get out of the trade. They're more short-term trades kind of thing. If I was really like I've got a leap on GE. I've got it like to the end of next year kind of thing. And so, that if I liked it like that, I will sell it well out there, not worry about selling it rolling it out every month.
Right, on that poor man's trade.
Uh-huh.
You buy the year call, the lead.
Uh-huh.
Do you buy it at the money mostly, or do you buy it?
Yeah, generally at the money. I mean, you could do it either way.
You can buy it further out.
You can buy it further. You can go 2 years out.
Right, but I'm saying I could get my strike price. I don't have to buy it at the money.
No, you
I
could
can
sell
go
the
on-
you could sell the 60 delta or the 30,
Yeah.
whatever you felt as.
And then you sell the short weekly call, you sell against it. You're selling, that's above the strike price on the purchase.
Yeah,
on the
I'd
purchase.
probably sell something like a 10 or 15 delta.
Okay,
Whatever because what you don't want is like, if you did a leap, you don't want to be in the money, you know what I mean? You want to generate good return, but not get too greedy.
got it.
Because otherwise, then you're in the money and you're like struggling kind of thing. Because the one thing about a poor man covered call is they're two independent trades. Like a covered call, you buy 100 shares and you sell a call, and if it gets in the money, it just takes your shares away, right?
Right.
But a poor man covered call, not that way. It's too, so you have to be aware of that. Because a lot of people will say to me, like, well, they'll just take money. No, they won't. They will give you, if you're short the calls and they assign you, you'll be short 100 shares and you'll still have that long call. Yeah, so
Careful, John.
anyway, so
Brian, is, Tom Sosnoff still involved with tasting?
I don't think so.
Didn't he open up something called the Loose Dog or something like that?
Lost dog.
Lost Dog.
Yeah, so
Have you looked at that?
I don't know what it is, but I mean, I just haven't figured it out. So
tried, but.
yeah.
Can't actually find anything. Really?
Yeah.
Oh, okay.
Well, I'm gonna end the recording. I appreciate you guys online joining us. I hope it was helpful. Let me see how to I'm gonna end this meeting. I hope